Welcome back to the Wealth Intel Report. Today, we're beginning a deep, four-part investigation into one of the most explosive and critical financial stories of our time, the Great Silver Shock of 2025. This isn't just a market rally. It's a fundamental, structural shift in a metal essential to both our technological future and financial security. In this first segment, we're laying the groundwork by examining the immediate catalyst that detonated this year's historic price surge. Let's start with the undeniable, headline-grabbing numbers. For the week ending December 26, 2025, silver surged an astonishing 18.1% to close at $79.32 per ounce. This performance wasn't just strong. It officially marked silver's best Christmas week on record, eclipsing even the massive surge seen during the COVID-19 pandemic panic buying in July 2020. To understand the scale, we need to zoom out. Year-to-date as of late December, silver is up a breathtaking 174%. To put that in perspective, it has dramatically outperformed its precious metal cousin, gold, which itself posted a very strong 72.7% gain. This price action isn't a slow, steady climb. It has been punctuated by days of breathtaking vertical ascent. On Monday, December 29th, silver briefly touched an all-time high above $84 per ounce before a sharp reversal. This kind of volatility isn't noise. It's a market screaming under immense stress. In fact, silver's December 2025 monthly gain of over 25% was its largest since 2020. So what caused this seismic move? The trigger was a one-two punch of geopolitical policy shifts that exposed a market already on a knife's edge. Catalyst number 1. China's strategic export lockdown. Starting January 1st, 2026, that's in just 2 days, China is implementing stringent new rules on silver exports. Under the new policy, companies wishing to export refined silver must obtain special government licenses, and crucially, they must meet two high barriers to qualify: an annual production capacity of at least 80 tons of silver and verified credit lines exceeding $30 million. This policy is not a minor regulatory tweak. It is a deliberate filter designed to block hundreds of small and mid-sized exporters who have been vital cogs in the global supply chain. The strategic intent is clear. China, which currently controls an estimated 60 to 70% of the world's refined silver supply, is moving to secure this critical resource for its own domestic industries. It's a page taken directly from its rare earth metals playbook, and the global market felt the shockwave months before the rule even took effect. Catalyst number 2. The U.S. declares silver critical. In November 2025, the U.S. Geological Survey published its final 2025 list of critical minerals, and for the first time, silver was officially added. This list, which grew from 50 to 60 minerals, identifies commodities essential to U.S. national security and economic stability that face high risks of supply chain disruption. The inclusion of silver wasn't an accident. As the USGS stated, critical minerals underpin key industries, drive technological innovation, and support critical infrastructure vital for a modern American economy. By adding silver, the U.S. government formally recognized what industrial users already knew: America is dangerously import-dependent on a metal it cannot do without. This designation opens doors to policy support, potential funding, and faster domestic project permitting, but it also sent a glaring signal to the market about silver's newfound strategic importance. The reaction from one of the world's most prominent industrialists was immediate and telling. Tesla and SpaceX CEO Elon Musk responded to news of the price surge and Chinese restrictions with a stark, three-word assessment on his X platform: "This is not good." He elaborated, "Silver is needed in many industrial processes." When the CEO of a company pioneering electric vehicles and renewable energy sounds the alarm on a raw material, the market listens. Musk's comment highlighted the core tension driving this crisis. Silver is not just a precious metal for investors. It is an irreplaceable industrial workhorse. The immediate effect of these twin catalysts has been a frantic global scramble for physical metal. Prices are not merely rising on speculation. They are exploding due to a fundamental shortage of the actual, physical metal. This has created a bizarre and telling market split. In Shanghai, where buyers desperately need real silver for industry, Physical metal has been trading above $80 an ounce, while paper futures contracts on exchanges like COMEX have traded at a significant discount. This physical premium is the clearest sign of a market in acute distress, where paper promises and real-world metal are becoming two entirely different assets. In our next segment, we will pull back the curtain on why this supply shock is so severe. We'll dive into the multi-year structural deficit that set the stage, investigate the alarming collapse of global inventories, and reveal the dangerous disconnect between the vast paper-silver market and the shrinking pile of real metal. This is where the story gets even more concerning. Stay with us. Welcome back to the Wealth Intel Report. In our first segment, we detailed the explosive price action in silver and the two immediate geopolitical triggers, China's export restrictions and its new status as a U.S. critical mineral. But these events didn't create the crisis. They lit a match in a room already filled with volatile fumes. In this second part of our deep dive, we move beyond the headlines to dissect the deep, structural flaws in the global silver market that made 2025's explosion not just possible, but perhaps inevitable. The core of the issue is a simple, terrifying equation. For 5 consecutive years, global demand for silver has exceeded total supply. This isn't a temporary imbalance. It's a chronic, structural deficit. Let's put hard numbers to it. In 2025, analysts estimate global silver demand reached about 1.24 billion ounces. Total supply from all sources, mining and recycling, only amounted to roughly 1.01 billion ounces. That's a deficit of over 230 million ounces. To grasp that scale, consider that this shortfall is roughly equivalent to the entire annual silver production of Mexico, the world's largest silver-producing nation. Every year, the world consumes more silver than it pulls from the ground, and the gap has been steadily widening. This leads to the first critical vulnerability: inelastic supply. Unlike many commodities, you cannot simply decide to produce more silver because the price is high. Approximately 80% of silver mining is a byproduct of digging for other metals, primarily copper, zinc, and lead. A mine's economics and operational scale are dictated by the price of copper or zinc, not silver. So even if silver prices double or triple, a copper miner won't expand operations just for the silver byproduct. Furthermore, developing a new, large-scale mine from discovery to production is a marathon, typically taking 8 to 12 years. Add to this a global trend of declining ore grades, meaning miners have to process more rock to get the same amount of metal, and you have a supply pipeline that is rigid, slow, and incapable of responding to a sudden demand surge. The second part of the equation is relentless, inelastic demand. Silver is not just a shiny metal for jewelry and coins. Today, industrial applications account for 50 to 60% of total annual demand. This demand comes from sectors that are foundational to the modern economy and the global energy transition, and crucially, there are no viable substitutes for silver's unique properties in many of these uses. Solar power. Every photovoltaic cell relies on silver paste for its conductivity. Electronics and semiconductors. Silver's unparalleled electrical conductivity makes it indispensable in everything from smartphones to advanced military systems. This industrial demand is what Elon Musk was referring to. It is non-negotiable. A solar panel manufacturer or an automaker can't stop production because silver is expensive. They must buy it at almost any price to keep their lines running. The International Energy Agency estimates that by 2030, the solar and EV sectors alone could consume half of all global silver output, squeezing every other use, including investment, into a fight for the remaining scraps. The inevitable result of years of deficit and inelastic demand is our third critical issue: the collapse of visible inventories. Global stockpiles that act as the market's buffer are being drained at a historic pace. COMEX registered inventories in the United States are down a staggering nearly 70% since 2020. Vaults in London, a key global hub, have seen holdings drop by around 40%. Inventories in Shanghai are at 10-year lows. Analysts warn that at current consumption rates, some key industrial regions now have only 30 to 45 days of accessible silver reserves on hand. This is not a comfortable cushion. It's a hand-to-mouth existence for global industry. This physical scarcity has exposed the market's most dangerous fault line, the epic disconnect between paper and physical silver. For decades, the market has been dominated by paper contracts, futures, ETFs, and derivatives that represent claims on silver. Today, that system appears dangerously overleveraged. The ratio of paper-silver claims to real, deliverable physical silver is estimated to be as high as 356 to 1. Think about that. For every 1 ounce of physical silver sitting in a vault, there are 356 ounces worth of paper promises circulating. As long as everyone is content to trade paper IOUs, the system functions. But when entities, be they industrial users, nations, or large investors, start demanding actual delivery of metal to secure supply, the illusion shatters. This is what's beginning to happen. The massive premium for physical silver in Shanghai versus paper prices on COMEX is the direct evidence. The market is, in effect, splitting in two. One market trades promises, while another, far more urgent market trades the irreplaceable, physical commodity. If even a small percentage of paper claim holders decide to take delivery, it could trigger a catastrophic short squeeze, where sellers are forced to buy silver at any price to meet their contractual obligations because the metal simply isn't there. In our third segment, we will explore the global chess game this shortage has ignited. We'll look at how the US and its allies are responding to this supply crisis, what it means for the future of energy and technology, and why silver has become a new front line in economic statecraft. The story is about much more than money. It's about power, technology, and national security. Welcome back to the Wealth Intel Report. We've charted silver's price rise and its deep supply crisis. Now, we zoom out to the geopolitical arena, where silver has been transformed into a strategic asset, a lever of economic power. The era of cheap, geopolitically neutral raw materials is over. The U.S. government made this explicit in November 2025 when it officially added silver to its list of critical minerals, substances deemed essential to national security. This was not a routine update, but a roadmap to reduce dependence on foreign adversaries. This action is a direct response to a profound vulnerability. America's heavy reliance on mineral imports creates risks for national security and economic prosperity. By designating silver as critical, the U.S. is signaling a major policy shift. It moves silver from the realm of free market finance into the sphere of industrial policy and national defense. But why now? The answer lies squarely across the Pacific. China's move to restrict silver exports is a calculated demonstration of supply chain weaponization. By controlling the majority of global refined silver and then tightening the export valve, China is executing a classic play for strategic advantage. This mirrors its earlier strategy with rare earth metals. The goal is clear: ensure Chinese manufacturers have privileged access, potentially stifling competitors abroad and forcing global industry to relocate to China. China's move to control silver creates a direct clash of strategic imperatives. Track 1 is fortifying the home front. The U.S. is actively trying to stimulate its own production. The critical minerals list is the blueprint, making investment in domestic mining a strategic priority. Track 2 is building allied supply chains. Recognizing no single country can be self-sufficient, the U.S. is aggressively forming friendshoring alliances. Multi-billion-dollar initiatives with partners like Australia and Japan aim to create a reliable, allied network for mining and processing outside of adversarial control. The stakes could not be higher. Silver sits at the nexus of the world's two most important megatrends: decarbonization and digitalization. You cannot build the green energy or advanced tech of the future without it. This transforms the silver squeeze from a market event into a systemic economic risk. As physical scarcity becomes the defining feature, analysts warn the traditional paper-based pricing system could break down. Price discovery would then shift to opaque, bilateral deals for physical metal, leading to even more volatility and insecurity for end users. Welcome back to the Wealth Intel Report. In this final installment, we turn our focus to the market's present turbulence and the signals that might illuminate the path forward. First, let's be clear about the current environment: extreme, historic volatility. The trading session of Monday, December 29th, 2025, perfectly encapsulated this. Silver prices soared to a record above $84 per ounce, only to plummet to near $70 hours later. This whipsaw action is driven by a clash of frantic physical buying, speculative positioning, and profit-taking. Several key market dynamics are flashing signals. First, the speculative frenzy. The sheer velocity of the rise has pushed silver into technically overbought territory. The relative strength index, a key momentum gauge, remained above 70 for weeks. This heat is evident in the options market, where bullish call options recently hit their highest level since 2021, and their cost has surged. This is the market equivalent of a crowd piling into one side of a boat. Exchanges are reacting, raising margin requirements for futures, which often leads to a shakeout as speculators are forced to sell. But beneath the froth, a bedrock of genuine physical demand is solidifying. Holdings in physically backed silver ETFs have surged by more than 150 million ounces in 2025, taking real metal off the market. Another key signal is the catch-up trade with gold. Investors watch the gold-to-silver ratio, how many ounces of silver it takes to buy 1 ounce of gold. Earlier in 2025, the ratio ballooned beyond 100 to 1, screaming that silver was historically cheap. Much of silver's massive rally has been a dramatic compression of this ratio. The playbook is simple. Gold moves first on macro fears, and silver eventually follows with even greater force. So, where do we go from here? The era of cheap silver is over. The structural deficit is permanent. Volatility is the new normal, as the massive paper market can trigger violent price swings on any shock. Ultimately, the investment thesis has evolved. Silver is no longer a simple inflation hedge. It is now a dual thesis asset, an industrial play on the unstoppable growth of green energy and tech, and a monetary and strategic hedge against currency weakness and geopolitical risk, a bet on its status as a scarce resource essential to national security. Looking to 2026 and beyond, the fundamentals are overwhelmingly constructive, but the path will be treacherous. China's export rules are now live. U.S. policy will increasingly favor domestic supply. The inventory buffer is gone. The physical market is asserting dominance over the paper market. For the Wealth Intel report, the key takeaway is this: we are likely in the early innings of a prolonged, multi-year bull market for silver, driven by a real, physical scarcity. However, this bull will ride a roller coaster, not an escalator. Investors must have the stomach for severe volatility and a time horizon measured in years, not weeks. This concludes our 4-part deep dive into the silver crisis. From the explosive triggers to the geopolitical chess game and the turbulent market reality, we've seen how a single metal is revealing the fractures and tensions in our global system. As always, do your own research, understand your risk tolerance, and think strategically. This is the Wealth Intel Report. Thank you for watching.